Welcome back. Earlier today, the producer price index was reported to have declined. But yesterday, we spoke about a really hot consumer price index number. So we're going to have to try to square that circle. How should the Fed react to this contradiction? And what was the reaction in the futures market? We're also going to talk about the CPI versus PPI, the relationship between the two reports. U.S. producer prices unexpectedly fall, goods deflation seen persisting. This is reported from Reuters. U.S. producer prices unexpectedly fell in December amid declining costs for goods such as diesel fuel and food, suggesting inflation would continue to subside and allow the Federal Reserve to start cutting interest rates this year. Really flies in the face from the hot CPI number we received just the other day. Well, we can see over here the producer price index. This is on a month over month basis, which does, by the way, include food and fuel, dropped more than the core PPI. Producer price index declined 0.13% month over month. Core PPI, which excludes food and fuel, declined only 0.01%. So, including food and fuel, it declined more. Now, producer price index year over year rose less than the core number, PPI. We can see here PPI 0.9% year over year versus the core PPI, which was up 1.7. So food and fuel are the weak components of this market. Notice, by the way, on the right hand side, consumer price index energy down 2%. Now, the report from the Labor Department, this is also from Reuters, which also showed prices for services were unchanged for the third straight month, implied a pickup in consumer prices last month was likely a blip. The hot CPI number, this is from Reuters again, says that that the hot number was a blip, an anomaly. We should not take it as seriously. Well, this is the Fed funds futures, the probability of the March meeting. And we can see the red histogram bar shows us a 70% chance now the Federal Reserve will cut rates to the 5.25 bracket from the current 525, 550. That flies in the face of just what we saw the other day with a 65% chance of a cut, a 33% chance of keeping rates unchanged. So the chances of a cut increased. The chances of keeping rates unchanged at the current 525, 550, the green bar, that went down. We're looking more like we're going to get a Fed cut. Now, PPI has declined more than CPI. Consumer price index, that's the green bars, we can see are higher than the producer price index, the purple bars. Now, in particular, we can see that this trend has lasted for quite a while. Now, when the CPI went up, the producer price index also went up year over year, but to a much lesser extent. This divergence between the two, by the way, is important. Core PPI, excluding food and fuel, has declined more than core CPI. So, excluding food and fuel, the same relationship persists. Both lines in this case, if you take out food and fuel, are continuing to decline to the downside. But notice the stark difference between the CPI, the higher number, and PPI, the lower number. Now, while producer prices decline, CPI is stubborn. The white line, by the way, shows us a very interesting calculation. It's CPI minus PPI. You see, when we go to the store and we buy something, we're paying CPI, Consumer Price Index. We're paying consumer prices. What it costs that company to produce that good, that or that service that we purchase, that's PPI. Now, again, while producer prices decline, meaning it's getting cheaper to make these goods and services on the producer level, the wholesale level, our consumer prices, what we pay in the store, are rising. That's what that white line shows us. That while producer prices are declining, consumer prices are not declining. They're not passing on the savings to us. It's a very interesting phenomenon that inflation is going down, but more so for the producers, not the consumers. And we can see here at 3.3% on CPI, we're only at 0.9% year over year. So the rate of increase or the rate of decline for producer prices or the increased consumer prices is growing. We can see this white line is very much moving to the upside. Now, the same pattern also exists for core inflation, excluding food and fuel. So we know it's not food or fuel that's really creating the skew in the number. The white dotted line is trending to the upside, which means the consumers, relatively speaking, since around 2021, are paying a relative higher price than what it costs for the producers to make these goods and services. While inflation continues to decline, the inflation for the consumer is a lot more sticky. And we can see here again, core CPI 3.9%. We spoke about this yesterday. Core PPI 1.7%. Now, the reason we mention this is because there's a very interesting inverse correlation between CPI minus PPI and the S&P 500. Notice the purple histogram bars. That's CPI minus PPI. On the left-hand chart, it was in negative territory. Now, the right side of the chart, it's in positive territory. So what it shows us as we move to the right side of the chart, it's where the consumers are paying a relative higher cost than what the producers are being charged to produce those goods. And notice the green line, the S&P 500, tends to move in opposite directions. So when the stock market goes up, the CPI minus PPI goes down. However, when CPI minus PPI go up, meaning when it's less advantageous for the consumer, when the consumers are paying more money, it translates into weaker stock prices. So it's not only, an unhealthy relationship within the economy, it's also having a direct impact to the stock market. The same pattern, again, also, by the way, exists for core inflation. That core CPI minus core PPI, when that goes down, on the left-hand side of the chart, that's a better environment for the consumer. The consumers are getting a discount. But when the consumers are paying a premium to the producers, well, that doesn't translate well. Now you'll notice on the right-hand side of the chart, the green line, the S&P 500, it's very close to all-time highs. Well, the question is, what's going to change if we expect this correlation to persist? Will the producers, will those prices catch up to the consumers? Will consumer prices come down? Or will the stock market come down? If we expect the correlation to continue, one of those has to happen. And again, the phenomenon is very interesting, and it's not something that we really see reported anywhere else. That core CPI or even regular CPI, when the consumer pays a higher premium than the producer pays to produce those goods and services, that definitely translates into lower stock prices. If you have not already, please join our brand new Substack newsletter, our first article entitled The Business Cycle, where we take a look at long-term business cycles determined by stocks, commodities, and bond yields. It's our first of many articles and long-form economic analysis that we intend to publish. And to do so, please go to the Substack website. It's completely free, no registration required, and simply enter in just the data. We'll provide links in the comments of this video as well. In addition, please don't hesitate also to visit our Twitter page where we post daily updates as well. We hope this has been helpful. We look forward to seeing you back soon.